Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney. We're counting down to Asia's major market opens.
I'm Annabelle Droulers in Hong Kong, and the top stories this hour. Asia set for a lower open after Wall Street fades at the close. The Dow Jones retreating from the 40,000 level as more Fed officials warn of higher for longer rates.
Jamie Dimon also sounding an alarm when it comes to lingering inflationary forces, telling us the chances of a hard landing are higher than markets think.
Plus, a busy Friday in China with high-level talks on the property sector, a first sale of special bonds, and April economic data that may show a modest improvement.
Speaking of data, Belle, we do have South Korea jobs just crossing the Bloomberg now. We are seeing that unemployment rate seasonally adjusted for the month of April, just sticking to 2.8%. The expectations from economists were 2.8%, and it's unchanged from the previous month of 2.8% there as well. We were expecting potentially a little bit more of a softness. In fact, Bloomberg Economics, for one, was seeing an edging up to 2.9%. We did see labour force participation potentially increasing in that month as well. But still, to be fair, these jobless rate levels around 2.8, 2.9% are still below that post-pandemic average of 3.3%. So Bloomberg Economics considering that to be the natural rate of unemployment, so neither pushing up or down inflation. So that tighter job market potentially giving the Bank of Korea a bit more leeway to take its time before cutting rates there. Labour force participation was one to watch here, and particularly when it comes to employment growth across manufacturers and a bit of softness in services being seen as well. So pretty muted in terms of the reaction that we'll expect to see when it comes to these jobs numbers. But as Belle said, a softer start to trading this Friday session as we head into the end of the week. Take a look at how Aussie futures are setting up here. We're seeing softness of about 0.6% there, mostly headed for early declines across the region too, tempering that optimism linked to the US inflation reading that we had midweek. So this reassessment of the path forward for the Fed is really at play here. We're seeing Chicago Nikkei futures looking pretty muted at the moment, and watching China as well after that early exuberance when it comes to potentially that report that we would see further action on the property sector. We are hearing that Chinese regulators will be talking about property aid when they meet with banks later on today, Belle.
Yeah, as we said, a very busy day ahead for China, not least because we've got that activity data as well due out in the next few hours. But let's take a look at how US futures are coming online this morning. It's fairly steady right now, but in the context of the day's trading session, where there are a couple of different notable factors, we had some twists and turns, but it was the Dow Jones that really stood out because we rose above or briefly touched that 40,000 mark. We closed just slightly below it. In futures here, you can see, again, trading around that level. The question, of course, is whether markets are now in overvalued territory, and we can put that to our guests, but across assets as well. We saw Treasury yields just a little bit higher, a bit of a bounce back in the dollar as well after it dropped to a one-month low, but concerns, as you say, Heidi, really building around inflation. We're about to hear from JP Morgan's Jamie Dimon on that, and then there's also Fed officials as well that you were speaking about who say that the central bank should be keeping borrowing costs high for longer. One of those as well was the Cleveland Fed president, Loretta Mester. Take a listen.
Incoming economic information indicates that it's going to take longer to gain that confidence. So holding our restrictive stance for longer is prudent at this point as we gain clarity about the path of inflation.
I think the surprise would be higher rates because inflation didn't go down. That inflation's been stubborn, maybe bounces up next year. I think inflation next year may be in the cards. It may have nothing to do with what you're seeing today. So that to me is the surprise.
Let's bring out first guest. Burns McKinny is a senior portfolio manager at NFJ Investment Group. Burns, always great to have you with us. So, that market exuberance reaction to the US CPI data, which if you strip out from the headline numbers, was still questionable in terms of inflationary pressures in that core. Is it unsurprising that, we're now seeing a reassessment of I guess, the reality check now?
It's not terribly surprising. We've been in this mode for the last couple of years where the equity markets are continuously trading based on what the inflation data is, because of the fact that that's what might determine Fed interest rate policy going forward. And the CPI print that we got this week in the U.S., it did seem to some degree deflate the notion or the narrative that maybe we might have a reacceleration of inflation. That said, we still feel like we're in a pretty good place there with respect to, Jay Powell and the Fed has basically said that, they're probably still, rates may be a little bit higher for longer, but at the same time, they're more likely to cut rates at some point this year than to raise them. And, really, they've kind of are in that sweet spot where they have time to be patient, despite the fact that interest rate policy, it works with a lag, but they started hiking rates 2 years ago. And despite that, unemployment in the U.S. has been at or below 4% month after month after month for over 2 years. It's been 50 years since we've seen unemployment stay this low for this long. And so that does buy them the time to be patient without having to worry about breaking something. It's sort of like if you're on a road trip and you're getting a little better mileage than you expected to get, well, maybe that means that you can go a little bit longer without stopping for gas. And so that does put the Fed in a pretty good position.
And do you go for the next 2, 3, whatever months until we finally get a rate cut, leaning into, those growth stocks and the mega caps, or do you start rotating now?
It's something that we would really advise investors start kind of layering into a portfolio now. And despite the fact that the lower rates actually in the near term could benefit some of the tech high flyers, we actually believe that right now is a really good time for investors to lean into value equities. They've been out of favor for a really long time, and so as a result, you do have valuations on your side. You've had last year the U.S. value index trailed the growth index by 30 percentage points, and historically, when it's trailed by that a margin, it's outperformed about 3/4 of the time over the next 12 to 18 months. And as a result of that lag, the value benchmark trades at almost a 50% discount to the growth index. And, if we're looking for a catalyst, we say, okay, well, what could maybe kick off that reversion of the mean? It may be that whereas the Fed may start lowering rates later this year, but the long end of the curve may actually stay a little bit higher for longer, which bodes well for shorter duration things that, the type of companies for which you're getting cash flow and earnings today rather than necessarily down the road. That could be the catalyst to, maybe get investors back into value stocks. They've been out of favor for over a decade now, and, maybe they get their due.
Are there any particular names that stand out to you, Burns?
One thing that jumps out to us right now is the fact that the investors, going back a year ago, investors were terrified that we had a recession was going to be a sure thing. And then toward the end of 2023, the soft landing narrative really started to take shape. And so investors had a bit of a flight to risk, and they started dumping a lot of the defensive areas. Places like utility, when the sun's shining, people aren't looking for umbrellas. And so you can play defense with a lot of utilities that are trading at a pretty steep discount to the market. A great example of that would be NextEra Energy. It's one of the largest utilities. Right now it trades at a discount to the S&P 500 for the first time in 6 years. Over that time frame, it's only about 5% of the time has it been this cheap. And a 3% dividend yield that they pay, it's not necessarily the highest yield of the utilities, but it's one of the best growing. They've tripled that payout over the last decade. And in addition to getting the largest regulated utility in Florida, right now, typically you pay a premium for that extra freebie that you're getting now. They're the U.S. leader in clean and renewable energy.
What about opportunities that are outside of the U.S.? Are there any specific areas that you're looking into in emerging markets, for instance?
Overall, we would argue that the emerging market space definitely holds promise right now. Again, they've been also out of favor, and they've trailed the U.S. for a really long time. If you look at price to book ratios, the MSCI Emerging Markets Index is trading at such a discount to the S&P 500. It hasn't been this relatively cheap since 1996. So you're talking of going back 28 years. And if there's really one thing that could drive a little bit of a comeback for emerging markets equities, it may be that if the Fed does finally get the freedom to lower interest rates later this year, that might weaken the dollar a little bit, which would actually potentially spur a bit of a comeback in the emerging markets.
And one of the incentives could be a better performance out of China, right? We've seen stocks come off the bottom. Clearly, valuations are still attractive, and we're hearing noises that maybe more policy action will be taken when it comes to the property sector. Does all of this add to, what looks like a fundamental re-rating when it comes to Chinese equities? Would this be a good entry point now?
In the near term, it's always going to be volatile in the near term. But for investors that have a 3, 4, 5-year time horizon, then right now actually might be a time to start chipping away at exposure to China. And it's starting to get a little bit of that momentum. You've seen really just major policy errors over the last several years, whereby you've had stringent COVID lockdowns that lasted probably a little bit too long. You had a regulatory onslaught against a lot of the technology companies in China, and a lot of those headwinds are starting to turn into tailwinds. They've reopened the economy. It was never going to go just a straight line smoothly. I always say that if you get your leg out of a cast, you have to walk before you can run. And they've ceased the regulatory pressures on the tech names. And with respect to bank reserve requirements, they've lowered those to levels that you haven't seen in about 15 years. So they really are providing stimulus, and you're starting to see the fruits of that. You've seen the GDP, the economy in China grew by a faster rate last quarter than the prior quarter, and at almost double the rate at what it was doing a year earlier. And despite that, beginning of a comeback of the economy, you do have very favorable valuations. I know China's had a little bit of a run since January, but you've got a market there that's still trading at about a 30% discount to its long-term averages, whereby U.S. stocks are trading at about a 30% premium to their averages. And so for long-term investors, there's definitely opportunities in China for the types of companies that might benefit from a growing middle class. You have a lot of companies that are sitting on tons of cash on the balance sheet. So looking for China, maybe dividend pairs with China is actually a bit of an unexploited area to look at.
Burns, thanks so much for your time. That was the NFJ Investment Group Senior Portfolio Manager, Burns McKinny there. And coming up later in the China show, we speak exclusively with Philippine Central Bank Governor L.A. Remolona as he signals rate cuts are on the way. That big interview coming up just after 9 a.m. in Hong Kong, 11 a.m. in Sydney, exclusive as well to note. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers go to Daybreak Go. It's also available on mobile and the Bloomberg Anywhere app. You can customize your settings so you only get news on the industries and assets that you care about. This is Bloomberg. China's government is said to be planning a meeting Friday morning with banks and regulators to discuss the property market. Sources say the agenda includes a proposal to clear excess housing inventory. For more, we're joined by our China correspondent, Min Min Lo. And Min Min, we've already seen property stocks rising in anticipation of this, but what do we know exactly about the meeting?
Yeah, it is a huge meeting. I think the breadth of invitees at this meeting really showcase how important it is. We're looking at senior officials from the Housing Ministry, from state banks, local governments. They're all attending via video conference to discuss this proposal to potentially buy back millions of homes across the country with the help of state-owned enterprises using loans from state banks. Now, of course, a lot of the details are yet to be sketched out. We'll be watching for that. The big question is how big of a scale is this going to be, and how are they going to finance this? Because if you recall, in early 2023, the government did roll out something similar on a smaller scale. They had extended about 100 billion yuan of credit through a specialized lending facility. The plan then was to get 8 cities on a trial basis to buy back excess housing. But as of March, only 2 billion yuan had been extended through that program, which shows the reluctance of banks and local governments to get on board. And banks, their balance sheets have been squeezed by non-performing loans and the fact that they're being asked to extend credit cheaply to developers. So these are all questions we don't have answers to. The State Council is going to hold that press briefing later this afternoon. PBOC is going to be attending along with relevant ministries, so we'll be watching out for details from that press briefing.
Big day for China watchers. We're getting the data dump from the National Bureau of Statistics in a couple of hours. The domestic recovery is expected to look a little bit patchy. What are we looking out for when it comes to property investment?
Yeah, property is still one of the biggest drags on the economy. We are expecting property investments to extend declines again. But that said, though, government-led investments could help counter that. And already we're seeing this steady drumbeat of pro-growth policies coming out in the last few weeks with a rollback of home buying curbs in city after city. And then now possibly a new announcement on this buyback of excess housing inventory. But of course, we're not going to see the effects of that on the April reading just yet. We will, though, however, feel the effects of last year's trillion yuan bond issuance that's being dispatched into infrastructure investment. We did see PMI reading for construction activity hitting a new high in April, so that's going to help fixed asset investments stay resilient this April.
Of course, it is a big data dump, so we get other things as well. Industrial production, retail sales. What's it going to tell us perhaps about the overall recovery we're seeing?
Yeah, economists' expectations is that we'll see the economy coming out of a lull as we head into the second quarter. If you recall, we had disappointing numbers coming out in March after a stronger than expected growth in the first quarter. The consensus is we'll see industrial production there on your screen leading a charge, increasing by 1 percentage point from March. That's on the back of stronger exports in April. Retail sales, that's a number that we want to look very closely at, because the big question now is, will we see a balanced recovery or this persistent trend of a two-track recovery with production and investments racing ahead of consumption? And if you look at the May Day holiday data, a huge appetite for travel, but per capita spending still not breaking above pre-pandemic levels. So people still keeping a tight grip on their wallet there.
Bloomberg's China correspondent Min Lo there. Well, Chinese President Xi Jinping and Russian leader Vladimir Putin have pledged to intensify cooperation against what they describe as Washington's containment policies. Bloomberg's Greatest China senior executive editor John Liu joins us now from Beijing. So this friendship without limits, what have we seen in terms of how far that's progressed with this meeting?
Well, I think what we've seen throughout the war in Ukraine is that that no limits friendship has certain limits. The Chinese have, while providing rhetorical support in places like the United Nations and providing economic support. China's still buying Russian oil, buying Russian commodities, exporting consumer goods and electronics to Russia. At the same time, China has not provided the weapons that Vladimir Putin, I'm sure, would love to see China supply to it. That has not reduced the tensions that its relationship with Russia has brought in terms of Beijing's relationship with Washington. We've seen Secretary Blinken raise on several occasions the issue of dual-use technologies that China supplies to Russia, things that can be used for both military and civilian purposes. And so it is something that we are still trying to figure out, but certainly some limits to that relationship so far.
What about the limits when it comes to China's financial system? Because we know Putin wants more access to that for Russia, but there's always that risk, of course, of U.S. sanctions.
That's right. The U.S. has made it very clear that any Chinese banks, any Chinese companies that provide assistance to Russia's war effort, provide materials that are used to fight in Ukraine will come under American sanctions. If you are a large Chinese financial institution, that is not what you want at this moment, to be cut off from the U.S. dollar markets. So that has been taken very seriously here. It is another reason that you see Beijing and Moscow both sort of talking about the need to cooperate to fend off U.S. containment. Beijing sees this as, the long arm of American hegemony, if anything else.
That was our Greater China senior executive editor John Liu there in Beijing. And meanwhile, the International Monetary Fund has criticized the Biden administration's moves to aggressively raise tariffs on some Chinese goods, including EVs. The fund says the U.S. economy would benefit more from open trade. The IMF has been stepping up criticism of its biggest and most influential shareholder over surging debt levels, trade restrictions, and even the currency impact of tighter Fed policy. And we'll have more ahead on Daybreak Australia. This is Bloomberg. Well, Heidi, we've actually got an update coming through this morning on what was a Bloomberg scoop that we had last week as well. It relates to this Optica Foundation, a foundation that's based in the US, and it has different research competitions. And what we understand is that actually Optica, from our Bloomberg reporting, had accepted funding from Huawei, which hadn't been made public before. Essentially, Optica, we understood, had chosen to conceal that. They said that that was a decision that would make sense for a variety of donors that choose to stay private. But in this case, of course, being Huawei, a Chinese company that is blacklisted, it has really raised the ire and eyebrows of many lawmakers as well. And we're actually hearing from two senior US lawmakers that have now blasted Optica for secretly accepting those funds. So they're saying that it really flies in the face of efforts to keep foreign adversaries from compromising US research. So again, that was an exclusive Bloomberg reporting, and now we're getting that response coming through from US lawmakers. And
remember when we spoke about this story last, when it broke on the Bloomberg scoop, it was truly extraordinary, right? It was sort of one of the ways that perhaps had been unexpected in the way that we could potentially still see Huawei influence and funding play a pretty significant role. And, you know, they were the sole funder when it comes to this optics competition. They said that they kept the role private to avoid appearing promotional. And now we are getting sort of some more details on that. We, at the time, had asked about, you know, what perhaps some of the researchers and academics felt about this, right? You're hearing from Liz Rogan, who's the Optica CEO, saying there's nothing unusual about this at all, that, you know, essentially trying to defend that. But we've also heard from the top Republican and Democrat on the House of Representatives Committee on Science, Space and Technology, writing to Liz Rogan saying that this was, you know, flies in the face of the increased risk awareness and transparency that they're all working towards in research, security and that entire space there. So they also said that that failure to disclose the involvement of Huawei showed either deep ignorance of years of policymaking around research security, or Bell, a willful strategy to launder funds from Huawei to bolster Optica's reputation and finances.
I think it raises more questions perhaps than it answers, and we know that there are a lot being posed to Optica now around whether it accepted other grants, donations, whether it's come from different countries as well. It certainly has cast a really big shadow over that program as well, especially because a lot of the researchers, we understood, were also unaware of where those funds were coming from. But we'll leave that there. As we said, that's the response we're getting from US lawmakers to our Bloomberg scoop. A quick check though on US futures, how they're going so far in the session, and broadly we're just seeing them fairly steady so far. Lots of sort of twists and turns over the prior session. Ultimately, we saw US equities closing a little bit lower here. Dow Jones, of course, one to note because we tracked above 40,000 or touched it for the first time. You think we were at 30,000 just back a couple of years ago. Question of the day from our MLive team as well on the blog. When are we going to reach 50,000 instead? So lots of things to be posing to what our markets guess over the next few hours. And we will have more ahead on Daybreak Australia. This is Bloomberg. Turning to the latest in tech, and JD.com's US-listed shares closed higher after better than anticipated 7% rise in first quarter revenue. Sales rose to $36 billion. That was just above the average analyst estimate. JD slashed prices and ramped up shopping perks to boost sales amid weak consumer sentiment in China. Baidu's ADRs edged higher after revenue grew at the slowest pace in over a year. Sales edged up just 1% for the last quarter, with net income coming in stronger than projected thanks to cost cutting. The results suggest Baidu is still struggling to translate its advantage in generative AI into real revenue. Investors are warning that TSMC's stock surge may hit a regulatory roadblock. Funds governed by restrictions on single stocks cannot add more TSMC equity and may even have to sell after this year's outsized gains. BNP Paribas says European regulations, which cap single stock exposure to 10%, mean it's now looking at other names 1 or 2 generations behind TSMC's technology. Sources say software maker Snowflake is in talks to acquire startup Rika AI for more than $1 billion. Rika makes large language models, and the move would expand Snowflake's efforts to offer generative AI capability. Tech giants have been rushing to partner or acquire startups that are working in that field. Let's get more on the outlook for AI now with our next guest. Joining us from Tokyo is Crawford Del Pret, President at Tech Industry Specialist IDC. And Crawford, thanks so much for joining us. And you're in Japan, of course, at this point in time, so we can get to what you're seeing there in just a moment. But I wanted to start off more big picture at this point, because we're really just seeing that global chip battle intensifying, and you've got billions of dollars that are being poured in from the US, Japan, even Korea is putting funding into it. They traditionally haven't done that. China, of course. Where do you see the leader really emerging in that competition for AI supremacy between the US, Western powers, and also what's happening in China?
Yeah, absolutely, and thanks for having me. So when you look at the overall AI semiconductor marketplace, and what's interesting right now is the way to play AI. It has been semiconductors, and the reason for that is that we are seeing an infrastructure upgrade right now associated with the core infrastructure we have in the cloud and how we need to process next generation workloads associated with AI. And those workloads right now are being dominated by US companies, which is primarily around Nvidia. And what's so interesting is people think about it just as a GPU play with Nvidia as a company that, maybe a passing fad. The reality is that Nvidia has developed a very, very significant moat, not only around the GPU, but around the software platform that you need to write applications for that GPU architecture, which is called CUDA. And so we believe that that is going to be a substantial moat for the company going forward, almost likened to what we saw in the client-server era with Wintel, where you had a software platform and a semiconductor platform that created an environment for innovation. And in a way, we're seeing that same setup with NVIDIA and their GPU and their CUDA software application, their CUDA platform. So I think that from an overall standpoint, right now, the Western architectures, primarily driven by NVIDIA, definitely have the advantage. And I think you're going to see that play out and continue to play out for a fairly substantial period of time.
And I want to keep talking about NVIDIA, because NVIDIA is one of the key earnings that we're going to be tracking next week, due the 22nd. But we've had so much investor enthusiasm around this stock and such sky-high expectations that we've seen across big tech reporting this season. Do you think that they can continue to have that market advantage or market edge?
Yeah, so look, the law of large numbers is going to mean that the absolute growth rate of the company is going to start to abate. But you're talking about a company that's going to grow, roughly around 80% year over year. And so I think you're going to see that there will be other companies. You're going to see AMD with very, very credible offerings in the marketplace. You're seeing Intel coming out with very credible offerings in the marketplace. And you're also going to see that is going to drive pricing, and it's also going to drive more competition in the marketplace. But as I mentioned, AMD and Nvidia and Intel are going to be using an open source software platform around their GPU architecture. NVIDIA is using their own CUDA architecture. And I think that that's going to still give NVIDIA an advantage on the infrastructure side, probably going into next year. So it really comes down to investor expectations and that expectation for growth. But make no mistake, the moat that NVIDIA has developed is a very defensible moat over time. The other thing I would add is that we're going to see the edge of the network start to become enabled by AI. So we're going to see PCs, we're going to see phones. As a matter of fact, by 2026, we believe about 60% of PCs will have an AI processor on them. That is a part of the market where Intel and AMD will participate significantly, and will be able to become more of a part of the AI investment that we're seeing in the overall market.
Crawford, we did want to get your views on China, the competition, how close potentially it's getting to be able to make, significant difference in closing the gap in R&D, but also your assessment of, how effective and I suppose the longevity of the chip hoarding that Beijing has done as well.
Yeah. So when you look at China, how effective the chip hoarding that's going to be a near-term opportunity. What's got to happen long-term is China has to develop an ecosystem. China has to develop an independent ecosystem for AI development, and that's going to be driven by by semiconductor companies, primarily companies like Huawei, and HiSilicon, as well as their startup infrastructure, which is going to allow a lot of custom silicon to be developed by a lot of the hyperscaler cloud providers that are out there. I think what you're going to see in China is you're going to see more of a lumpy road. You're going to see situations where they've got to be able to develop leading edge technology for their own uses internally. And I would say that we'll probably see some of the hoarding that happened run out, and then you'll see cycles develop in China where we're sort of transitioning to their own inside of China developed architectures, which again may mean for a lumpy environment going forward.
Crawford, how much more difficult do you expect the environment to get? Of course, we're going into November. There's geopolitical posturing at play here as well. Or do you think the bifurcation, the competition and the strategic competition in this is already pretty well set?
I think you're going to see that the competition is fairly well set. I think you're going to see, from a China standpoint, it's really going to turn into how quickly they can internally within China innovate. And I wouldn't underestimate. I just think you're going to see a bit of a choppy environment. But I don't think you're going to see things get a lot worse in terms of where we are today and how China's able to either access the technology they're able to access today or be able to develop their own technology going forward. But as I indicated, that's going to take some time, and I think that's going to contribute to some of the lumpiness that I'm describing.
Crawford, we've seen Japan really making big efforts to attract international chip makers to its market. They also have very ambitious chip plans. You're in Tokyo right now. What are the sorts of conversations you're having, the tone, and are you seeing real progress on that front?
Yeah, we are seeing progress. I mean, when you look at the investment that you're seeing in Japan around semiconductors, Rapidus is investing heavily to be a leading supplier here in Japan. And they're not only looking to build a foundry capability, they are looking to build an ecosystem up in the northern part of the country. And I think that as well, TSMC making an investment in Japan is going to drive a significant amount of innovation and creation of a new ecosystem. I think you really have to think about, people think about sort of the old way Japan thought about the semiconductor industry, which was more of a captive industry where Fujitsu made chips for their own uses, NEC made chips for their own uses. Now we're moving into a new era where you've got companies like, for example, Toyota, or Honda that are going to be making edge devices in the form of driverless vehicles. They have a motivation to be able to work with a local supplier here to have a significant access to technology. And I think that what you're going to see over the next decade and even sooner is the investment that is happening in Japan around semiconductors will mean that we'll see a new engineering ecosystem start to develop. That's going to include AI, but it's also going to include leading edge foundry capacity that will represent incremental ability to have semiconductors available all across the world from Japan. And so I think it's really a rebalancing, if you will, of where we can expect to see not only semiconductors made, but where the engineering around semiconductors happens. And I think you're going to see that shift in Japan. I'm definitely seeing the signs of it now.
Crawford, this is kind of I guess a big picture, maybe a bit of a moonshot question, but what is next when it comes to AI? There's been a lot of excitement over, the intersection of quantum when we finally get there, particularly here in Australia, huge amounts of government and private investment. Is that something that you're watching? And can you give us an indication of, what that would look like?
Yeah, so before we get to quantum, let's spend a little bit of time in terms of what's going to happen with AI. So the stage was sort of set for AI a number of years ago with the emergence of the cloud and the emergence of mobility and the emergence of high-speed networking. So now we're seeing that AI is pervading what we call horizontal use cases, and that's what you're seeing with things like Google Gemini and things that you're seeing with things like Copilot from Microsoft and obviously ChatGPT. The next phase will be AI starting to pervade what we call industry use cases. So AI will become embedded into software applications that are used in functions within the enterprise, like sales or like client services or like HR. Then you'll see AI moving into vertical applications where we see it used in healthcare, or we'll see it being used in manufacturing, or we'll see it being used in financial services. So we'll see sort of wide AI being, pervasively being used in all these different kinds of applications. Quantum will come even beyond sort of, we now have AI assisting in jobs in all these different vertical use cases, and that'll happen over the next couple of years. Quantum we won't see widely used for many years, where we'll start to see quantum processing very, very complicated workloads, workloads that are around things like simulation, workloads that are around areas like advanced security, and I think that for quite some time. We're not going to be, quantum's not going to be something that individuals or even large-scale enterprises are touching to a large degree. The big change that we'll see in AI is that today, over half of the investment in AI is happening at the semiconductor level. By 2027, it'll happen at about a third will happen at services, a third will happen in software, and a third will happen in infrastructure, including semiconductors. And that's going to be the big shift. More parts of the ecosystem will be participating in the AI industry.
Crawford, really great insights. We appreciate your time with us, Crawford. Del Prete, who's a president at IDC. Get more ahead on Daybreak Australia. This is Bloomberg. JP Morgan CEO Jamie Dimon says the US has to stay engaged with China. Speaking with us at the bank's Global Markets Conference in Paris, Dimon says Washington and Beijing have common interests and are not natural enemies.
So the geopolitical situation is very tense because of Ukraine and Russia, Iran, the terrorist activities in Israel, North Korea, nuclear blackmail. We've never had nuclear blackmail before, and this is, of course, affecting our relationship with China. And it's going to be hard to have a great relationship with China as the Ukraine war is on. We're kind of on different sides of that, and put Taiwan aside. Having said that, I think it's the right thing for America to fully and deeply engage with China, competitively. Every nation is going to do what's in their own interest for national security. So should America. We should define that fairly and properly. If there's unfair trade, negotiate that or do whatever you need to do. But the engagement is the right thing to do. China is not a natural enemy of the United States. They have a lot of their own problems. So, to me, we can work together as best we can. And then we have common interests: climate, anti-nuclear proliferation, anti-terrorism.
But what does it mean for a bank working in China, actually, given all of this volatility?
They're cautious. I mean, China, if you look at China from a risk-reward basis, it used to be very good. It's not so good anymore because all these things can go wrong. And remember, we bank, I've got the number, but 1,500 multinationals in China. They're not leaving China, so we're going to serve our clients there. We're just much more cognizant that the risk is higher. And I put Hong Kong in that bucket too. We kind of look at China, Hong Kong as one at this point from a risk standpoint.
What does the Trump administration mean for the U.S. economy?
I don't know.
Why? Because it's unpredictable, or because we're too soon to actually trying to figure out the policies that he would put in place?
So if you look at history, who was elected president may not necessarily affect the next year. That's kind of like we're a big tanker and that's going to happen. I think the much more important thing is what we do in the geopolitical situation I've always been quite clear that American leadership is provided to keep the world free and safe for democracy. And that means economic alliances, which includes trade, by the way. I think we should spend more time in trade. It means NATO. It means that Russia should not win in Ukraine, because if they do, I think it can tear asunder this Western world.
I know you've ruled out being Treasury Secretary.
Yeah.
Why? What would it take to get you into politics?
I don't think I'm suited for politics. I love my job, and so I'm not sure I want to do something like that. And I can hopefully.
But even if you got the call, would it be hard to say no?
I don't know. Probably yes. I love my job, and I have no interest in leaving or doing anything else. So.
That was the JP Morgan CEO, Jamie Dimon, speaking to Bloomberg's Francine Lacroix. And quick check on markets now, because we're just about 10 minutes out from the open for Sydney, Seoul and Tokyo. And broadly, we're setting up for a bit of downside pressure today. Tracks, again, the US session overnight. We did have a few jitters coming through around the inflation outlook. We heard from Fed officials saying rates should stay higher for longer. Watching, of course, Nikkei futures there. That's the Singapore contract, but pointing to a drop of 0.7%. What's very interesting dynamic that we're seeing in Japan at the moment, because with all of the investor interest and exuberance in Japanese equities this year, we had seen other markets that have ETFs that track Japanese assets, including in China, really overheating here and trading above their net asset valuations. Now we're actually seeing the flip side scenario coming through in Japanese equity instead, because the rally in Chinese stocks is giving a fresh impetus to a host of ones that are in Japan. Those with exposure to China are rising along with their counterparts, and a rebound as well in the MSCI China Index. Let's get more from our Asia equities reporter, Winnie Zhu, joining us from Tokyo. And that rally that we're seeing from Chinese stocks, it really seems to be spreading now to other parts of Asia.
Yeah, so it seems like we're seeing some signs of some reversal of an earlier trend to buy Japan and sell China, especially as Chinese stocks are really rallying these days on cheap valuation, on the policy support. And that's been supporting some of the Japanese stocks that have high exposure to the Chinese market and Chinese economy, specifically in cosmetics like Shiseido, that was also impacted earlier by the boycott around the Fukushima water release, and also industrials that heavily rely on Chinese demand. So from their earnings presentation, we're hearing companies saying that the China demand or inventory are improving. And also analysts are saying that pretty much the worst has been priced in, and that's over. However, in terms of what level of recovery we're going to be seeing and when that recovery is going to come, that still remains uncertain. But definitely we are seeing the signs of things bottoming, and these stocks are on the uptrend to rebound.
Overall, for Japan, how are we doing? Because, of course, the redirection of flows from China was one of the big kind of factors to begin with at the start of this rally. Are we seeing money now flowing back?
To some extent, some people say that it is kind of a near-term risk to watch. However, most people say that Japanese stocks are right now in range-bound. That's mostly driven by more macro factors, whether it's a geopolitical tension in the Middle East or the more hawkish tone from the Fed. However, once that macro factor is over, the fundamentals of Japanese stocks still remain strong, although dollar-based investors are still quite cautious when it comes to the currency volatility, as we're seeing that dollar-based return for Japanese stocks are actually lagging its peers, its global peers right now. So when we spoke to BlackRock, they also mentioned that we will have to see the currency to stabilize around the level of 150 against the dollar in order for global investors to feel more comfortable coming back into Japan. So that would be some of the factors that we're watching.
Our Asia equities reporter, Winnie Zhu there. We have more ahead on Daybreak Australia. This is Bloomberg. Elon Musk's satellite company Starlink is transforming communications across the globe. Bloomberg Originals has been looking at how its dominance is sparking government scrutiny and encouraging deep-pocketed rivals.
The largest single constellation of satellites orbiting our planet is run by a mercurial individual who needs no introduction. It's this guy. It achieves this by maintaining a vast relay network in low Earth orbit. That's the area higher than a jetliner, but below a GPS satellite.
Right now, Starlink has more than 5,600 satellites in orbit.
And it accomplished all this in less time than it took James Cameron to make a second Avatar movie.
At one point, SpaceX envisioned launching up to 42,000 satellites.
But this speed and relative success has raised eyebrows, concerned ones in government, and excited ones in the boardrooms of potential rivals.
It's essentially a company trying to disrupt a somewhat complacent marketplace.
And you can see that Bloomberg Originals documentary in full on their YouTube channel. And for more inside stories of investments beyond Earth, from satellite networks to moon landings, you can also visit bloomberg.com/space. So that's the business of space, but let's also just check on the business of currencies as well. And we're taking a look at the Japanese yen this morning. It is just a little bit weaker against the greenback here. We did see a bit of a rebound coming through for the dollar as well, but trading around that 155 mark here. We're hearing again from Japanese government officials, Suzuki certainly saying that he's keeping the risk of rising yields weighing on the budget in mind. They're still committed to that fiscal consolidation goal as well. So just some of the headlines that we're monitoring here as we also hear from a former BOJ official saying that rate hikes could be on the way.